If you're a Starbucks shareholder or you're interested in Starbucks stock, then you're going to want to watch this video to learn why Starbucks stock is down almost 10% today after such a strong earnings report they just reported last night. We're going to dive into that, and I'm going to tell you what I think about the stock and if I'm a buyer at these price levels. All right, so here's the deal. You can see right here, stock is down almost 9% today. And here's a quick look at their earnings report from Seeking Alpha. So GAAP earnings per share of 74 cents. I'm sorry, non-GAAP of 74 cents, which beat by 9 cents. Revenue of $8.7 billion, which beat by $270 million. Q2 comparable store sales up 11% globally and up 12% in North America, right? Probably their most important market at this point in time. Up 7% internationally. Active Starbucks Reward membership reaches 30.8 million, up 15% over the prior year. And so when you think about that, those are people with, a Starbucks card. I have one myself. People that have a membership and a card are much more likely to put money on it. And that's almost like guaranteed future revenue for Starbucks. And so that's a very impressive number. They opened 464 net new stores, inclusive of closures across North America and international, as part of ongoing efforts to strengthen the portfolio, ending the period with 36,634 stores globally. 51% are company operated and 49% are licensed. And then this was from yesterday. They're going to talk about their results at 2 p.m. Pacific, which again was yesterday. So why is the stock down today? Well, the stock is down today because of that conference call and because of the price to earnings multiple on the shares. I'm going to get into that in just a second. But essentially, the stock was priced for perfection. It was priced already as if the market was expecting a strong quarter this quarter, not only this quarter, but in the future. And what happened on the call was management got asked. So here's a comment from one of the analysts on the call. Essentially, they asked to management, why aren't you increasing your guidance for future quarters and for the rest of the year when you just beat this quarter? Are you seeing some weakness there? Is there a reason for that? And here's the CFO's response. Forgive me, I'm going to read this because I think it's important to take it in. The way I'd look at it is we are incredibly pleased with the performance in Q2. But when you think about, as I shared in my prepared remarks, we benefited from the lap of Omicron, as well as the one-time adjustment from the STAR liability that was expected. So we expected that, and that was driven in the comp, what they compared to last year, that we saw in the quarter in North America, as well as broadly. In addition to that, while we recovered better than what we expected in China, so they had strength in China, when we look out towards the balance of the year, we expect our average weekly sales in China to continue and increase, to improve sequentially quarter over quarter, but at a more moderate pace than what we saw in Q2. So some signs that, they're not expecting things to continue to outperform as much as what we saw in Q2. We've already seen it start to moderate. Okay. So when the market and analysts and investors see that, their ears perk up and they're like, oh, you're already seeing it moderate. And that's really driven by the fact that there's still some uncertainty in the overall environment from a recovery standpoint when you look at things like consumer behavior, as well as recovery in key segments like our international travel. So when we take all of that into account, when we look at our guidance for the full year, we believe reaffirming our guidance allows us to continue to convey the momentum, but also for the confidence we have while still navigating a rather uncertain environment globally. So all of that to say, it's a bunch of fluff essentially to make it sound good, but to say, hey, yeah, we're acknowledging we did outperform. It was kind of because we had an easy comparison. So let's keep that in mind. But we're seeing some things and there's some unknowns out there in the economy that we're not confident enough to boost our guidance by the amount that we beat by because of all of those unknowns. And so that's what the market is keying in on. Now, the question for investors is, hey, if you own the stock, like what should you do? Should you buy or sell, buy more, sell, or whatever? And if you're not an owner of the stock, but you're interested in the stock, what should you do? And I don't personally own shares right now, but let's jump over to Fast Graphs and we can look at kind of the historical valuation of Starbucks as well as the performance. And I'll let you know if I think the stock is a buy or not at these prices. And if not, what prices I'd be willing to buy. So first thing I like to do is I like to go to performance, and I just like to see how stocks have performed over a long period of time, because past performance does not indicate future performance in terms of, hey, they did this percent, they're going to continue to outperform or underperform by this percent. But when we're looking at stocks, we're talking about companies. And companies, when they do well, they tend to continue doing well over time. And if you think about that, it makes sense, right? If a company does well for an extended period of time, it probably means they have a good product, they have good management, they have good growth tactics, and they're growing into new markets. They have good marketing, they're taking more market share, the brand is getting more popular. As it becomes a good place to work, or a more stable, steady brand, more people want to work there because it's a good job. All of those reasons are why a good company over 20 years is kind of a nice thing to invest in, right? If it's at the right price. So since we're going back since 2002, compound growth, if you had invested at $10,000 in Starbucks at that time, you would have earned $28,000 in dividends, which is pretty awesome. And then you'd have total growth, dividends and stock price of $269,000 on your $10,000 investment. That's pretty incredible. So compound growth per year is 17%. And if we compare it to the S&P 500, if you just invest in an SPY index fund, you would have still had an awesome return, but you would have returned 10.28% per year, and you would have gained a total of 74,000 versus that 270,000. So Starbucks is a very, long-term outperformer of the market. Let's go back basically just 10 or 11 years. Starbucks is still outperforming the market. Let's go back just 3 years. Even over 3 years, Starbucks is outperforming the market. So over a 20, a 10, and a 3-year period, Starbucks is outperforming the market. The other thing that I think is really awesome is this dividend growth, right? So Starbucks pays a dividend, and the average growth rate over the 12 years that they've been paying the dividend is 29% per year. And we can see that up here. They started paying the dividend in 2010 at 11 cents per share, basically. And then go to full year 2020, you're at $1.96 a share. And what's really awesome, this is one of the coolest things in the world about dividend stocks that grow their dividend over time, is yield on cost. What this shows you is the dividend yield on the cost of the shares that you paid when you initially started your investment, right? So based on what the shares cost in 2010, if you look at the dividend you're getting, the $1.96 dividend you're getting today, that is a 45% yield on the cost of shares that you paid in 2010, which is just incredible, right? And so, that's kind of the power of dividends. That's the power of dividend growth. And it's truly incredible, right? That makes up a lot of the reason that people, invest in Starbucks. So let's look at the current valuation. And I'm going to tell you if I think the stock is over or undervalued using FastGraphs, which is one of my favorite tools out there. Right now, what you can see, and this does not take into consideration today's price. So the stock's at about $104 today. So this number's down a little bit, but immediately what I look at is the blended PE ratio of 35.38. If we look over the past 20 years, the average PE has been 32. So we're sitting a little bit above the high end of its PE over time. The other thing we have to look at is how fast they've grown earnings during that time period. They've grown it at an average of 16% per year. So if we think earnings are going to continue to grow at 16% plus per year, then paying, a 32 PE could work out if we look at, historically how this thing has traded. If we jump over to analyst estimates, this graph right here takes into consideration analyst estimates for 2023, 24, and 25. Basically, the next 3 years. This is fiscal year 2023, which is a year ahead of calendar year, right? So about 3 years from now. If they hit these expectations of about 16% growth, about 18% growth, and then about 17, so an average of 17.16%, between now and then, and it stays at this PE of 36, then you've got a total return of 52%, which is about 19% per year. That's pretty incredible. I don't think it's going to do any better than this. So I think that is certainly like the absolute best that I would think if I was going to invest in Starbucks. That would be like the top return expectations that I could ever rationally expect. Things can obviously get crazy, but I think that's like a fair bull case scenario. I think a 25 PE is definitely a base case scenario and you can see at a PE of 25, you would get a total return of 12% for about 5% per year. I think that's probably a more realistic expectation to think that it would trade at about a PE of 25 3 years from now. If we jump down to a PE of 18, which is, about what the market trades for, which is a major cut for Starbucks, right? It's almost always traded at a premium to the market, to the S&P 500. But I think this is like a fair bear case scenario over the next 3 years. Then you're looking at a total return of minus 16% for minus 7% annualized. If you invested $10,000 today, it'd be worth $7,851 in 3 years. I think that's a fair bear case scenario. But then obviously what you would do is you would be collecting dividends the whole time. If you're reinvesting, then you're buying more stock at lower prices. And if your time horizon is longer than 2025 and you continue to hold shares and reinvest dividends, then you can do, really well on the stock from there. So my decision for me personally, I don't own the stock right now. I don't plan to buy it immediately. If it came down a little bit and we saw it trade down to a PE of around 25, which is another, 10, 15, 20% lower from here, I'd be very interested in the stock. It is yielding, the dividend yield right now is 1.85%. If I saw this thing come down a lot below 100, I would start to get really interested in potentially owning shares. That's all for this video. If you liked the video, let me know in the comments and let me know by liking the video and subscribing to the channel. That helps YouTube surface it to more people and it helps these videos get found. If you want more from me, subscribe to the channel so you never miss an update. And then my email newsletter, austin.substack.com, is linked in the description below this video. So thanks for watching. Hope you have a great day and hit me up in the comments.